The big news from last week was the yen intervention, and if you thought that was it, you might be wrong. Today, we're going to break that down. We're going to talk about some potential interest rate hikes that are coming up, and we're also going to look ahead to one of the biggest headline news events in the Forex market. What's going on, guys? AKIL'S here, as always, and welcome back to another episode of the Trading Coach Podcast. And yes, we're back on video, so welcome back to the YouTube audience as well, although I saw you yesterday with our Trading Edge video. So last week, I did an episode of the Trading Coach Podcast talking about the Bank of Japan's interest rate decisions, and at the very end, I asked you guys, hey, do you enjoy these current event, I guess you can say, style topics? And the answer was an overwhelming yes. So, as promised in yesterday's Trading Edge video, we're going to dive right back into some of the headline news events for this week and a big one that ended last week. And I guess we'll start with that one, which is going to be the Japanese yen intervention. So, this past Thursday, Japan finally did it. They stepped in and they intervened with the yen. Now, I'll explain exactly what that means in a little bit, but if you remember, for a few months now, Japan has been sending verbal threats. I think they call it jawboning, but they've been putting forth verbal threats of saying, hey, we're going to intervene if, we're going to intervene if, we're going to intervene if, and they've been giving some very specific numbers like $1.60. Now, they've done this in the past, and the idea of this verbal jawboning is to scare the market into saying, hey, we should start buying the yen because Japan says they're going to buy the yen, and we don't want to be on the other side of a central bank. But it didn't really work. So after that failed, they went to plan B or plan C, D, whatever you want to call it, and said, hey, we'll just step in and intervene and get this party started ourselves. Now, as I mentioned, this isn't the first time that they've done this, but it is the first time in I think about 2 years. I want to say 2024 is the last time that I remember. Now, quick refresher for you guys, right? Currency intervention is this. This is when a country's central bank steps in and either buys or sells its own currency directly to influence its strength or weakness. And from a trading perspective, this is actually one of the reasons that I love trading the yen, right? It's always been one of my most popular pairs when it comes to getting home run trades. And those are the trades where I shoot for very, very big targets. Because Japan is so blatantly in your face about what they are thinking and what they are going to do, it makes it very it makes it very easy for an investor or a trader like myself to be able to tell if you're on the right side of the market or not. Now, again, it doesn't affect my decision making in the market from a technical perspective. I still form my bearish and bullish bias based on what I see on the chart. But if my technical bias happens to align with Japan's fundamental bias, then sometimes you can let it ride a little bit longer than you normally would and make those home run profits. So right now, Japan is on a holiday period called the Golden Week, which runs through May 6th, which I think is Wednesday. And to be honest, it's not surprising at all that we saw this intervention happen during this period. If you remember, right, way back in Trading Coach Podcast, episode 1297, right, how liquidity affects the market, you'll recall that thin markets are the perfect opportunity for explosive moves because lower liquidity means it takes less effort to move price. And before the holiday started, Finance Minister, I apologize if I butchered the name, Suzuki Katamaya, basically telegraphed what might be happening by telling reporters to keep their smartphones on hand during the break, right? There we go. Blatant little hints. Now, depending on when you're listening to this, I'm recording this Monday morning, so I'm not sure when it's going to be out for you, but there's already more rumors that Japan's Ministry of Finance may have stepped in again or maybe planning on stepping in again today. So now, the big question that I know you guys are pondering, so I'm here to answer it for you. Will this actually work? Well, if we look at the charts, you're going to see that we have established a pretty clear floor. Price action has come down initially from a little bit over just about 161 even all the way down to about 155 half. And then we've tested that twice for the double bottom that we spoke about in the Weekend Trading Edge video. And since then, we've tested it again. And from a technical perspective, this is a chartist's dream, right? These wicks down here, for you guys watching the video, if you're not watching the video, imagine candles with very long wicks to the downside. These wicks show us a clear level of rejection. This gives us a clear zone, again, right about 156 to 155 half of what the market tolerates. It will tolerate yen strength, but only to this level, as each of the last 3 times it has gone down to that level, it has been bought up, bought up, bought up. Now, with that being said, the market hasn't really been able to make any movements as far as a correction off of that level, right? So we have a floor here at about 155 half, but we also have a nice little ceiling that's been protected so far by the yen at about 155 or 157.37, or just call it 157 even. It's around that area if you don't want to be specific. So right now the market is in consolidation, and again, from a technical perspective or from a fundamental perspective, you want to be aware of any future intervention, and that's why the market is a little bit scared, I would say, hence the consolidation. But from a technical perspective, our job is easy. To look for the trading opportunities that we spoke about over the weekend, all you have to do is wait for a clear break and violation of that high point, or if we want to look for continuation, wait for a clear break and close below this low point. This is what we call being predictive in our analysis and reactive in our execution. We don't want to jump the gun too quickly. Rather, we want to wait for the market to give us clues of which direction it's more likely to go in. And then once the market does give us those clues, get ready for it, then we bounce. That was weird. Let's not do that again. Now, from a fundamental perspective, we've still got the structural pressure keeping the yen weak. Not much has changed from that perspective, right? Bank of Japan is still very slowly, if at all, raising rates, and the Fed here in the US isn't cutting anytime soon. Plus, you got the impact of oil prices on Japan's imports, and it's not getting the boost I think it wanted from this intervention. The market isn't falling for this trick, not quite yet. And again, just like the verbal jawboning, part of that intervention is to try to convince us that, hey, the yen should be looked at as being strong. We need to jump on this bandwagon. And although we saw this short-term movement, the long-term story is still up in the air, but we'll see. All right, so that's what happened last week. Coming this week, we're going to start off with Tuesday. We have an RBA rate decision. RBA is the Reserve Bank of Australia. And the expectation is that they're going to make a 25 basis point hike. This would be the third consecutive increase, bringing their interest rates up to 4.35. Now, this is all in line with the market expectations, as the RBA has been clear that inflation is still above their target and it needs to be controlled. However, there is a little bit of uncertainty that's making its way into the mix. Mainly that geopolitical tension, which is the Trading Coach podcast code word for war. That's maybe not really war, in the Middle East, and the resulting energy shock. So, as always with these news events, the real focus isn't necessarily on the hike itself. That's kind of been priced in already. It's going to be about the future guidance. So what do they say going forward? And remember, big market moves come from deviation from the expectation. That means when something comes out that is different than what the market already projected. So if everyone expects to hike, right, a hike alone isn't going to do much to the market because that's been priced in for however many months. But what could move the market is this: a sign or a signal that more hikes are coming in the future, and that's not out of the equation at all. I think that's a little bit expected, which is why it would maybe cause a tiny reaction. What would probably cause a bigger reaction is the expected hike, followed by a statement that says, hey, we're done. And what would cause the biggest reaction, this is the wild card, would be no hike at all. In my professional opinion, that would cause the markets, as the kids say, to go crazy. Speaking of crazy, something that always makes the market go crazy, at least historically, is the NFP, the Non-Farm Payroll. And that's what we got. Happy first Friday, right? For you guys that are new, the first Friday of each month, for the most part, We have jobs day here in the US, which is a flood of different job numbers like average hourly earnings and unemployment rate, with the main event being the non-farm payroll. Now, although the NFP may be more popular, especially around social spaces, than an interest rate decision, it's really not as impactful as it. But it's got a reputation of must-watch news, and well, with the markets being a visual representation of all of the market's participants and the actions that we are taking, if we think it's must-watch, then the market thinks it's must-watch, right? Now, again, I'm not saying that jobs don't matter. We know that they are one of the two main drivers when it comes to monetary policy. I'm just saying that the hype is more about the consistency of the release and everyone gathering around to get excited versus anything else. Anyway, the current expectation for this week's report is going to be about 73,000 new jobs. Now, in a healthy US economy, you'd normally expect somewhere in between 150 and 200,000 jobs per month, which is roughly where we were at in March, if I believe. I think it was like 173K. Anyway, 73K, if my math is correct, is slightly lower than 150K. So, probably not a great number. Now, do keep this in mind. The March number was a little bit inflated. There was like a healthcare strike that was over, so they returned to work. So it's not a perfect comparison, but I think it's safe to say we are going to undershoot that number drastically. So the question is, should we go into an all-out panic knowing that this number is going to be low? Probably not, right? The number is already expected to be low. If it meant something of worth, the market would have reacted to it already. The fact is, I don't think the market really cares about this number too much, mainly because our Fed chair has come out and said they don't really care about this number too much. This isn't going to be a direct quote, but I remember Fed Chair Jerome Powell recently mentioning that the labor market is softening, job gains are slowing, demand for labor is weakening, and the overall conditions are cooling. However, unemployment is still relatively stable and close to what they consider to be a natural rate. He also made it clear that the labor market is not currently a major source of inflation, and that's the key because right now the Fed's primary focus is on inflation. So, while the non-farm payroll does matter, I wouldn't be surprised if we just saw a quick spike in volatility, that initial panic reaction, followed by price correcting itself and settling back into where it started. Now, I've got all types of war stories when it comes to the non-farm payroll, as young Akil did some dumb Akil things. I think I actually explained that in the same podcast I mentioned earlier. What is it, 1297? Whatever one we speak about liquidity in. I think I do. If not, then I can always tell you those war stories again. Anyway, that's all I got for you guys this week. Remember, don't get caught up just reading the headlines. The real edge comes from understanding how those expectations are priced in and understanding where the market could be right and where the market could be wrong. If you enjoyed this episode and want more breakdowns like this, maybe we can make it a weekly Monday thing. Just let me know. Type it in the comment section below. While you're there, follow, subscribe, share, do all that fun stuff. Oh yeah, and if you ever want to learn how to trade, check us out, www.tier1trading.com. We've got courses, we've got community, and we've got awesome coaches to walk you through that trading journey. All right, until next time, plan your trade, trade your plan. Take care.